Catch me when I'm doing just grinding. Haters wanna hate, let them hate, never mind them. Be more bitch, tryna reach the next plateau. And I can't stop till I achieve my goals. Keep a couple feeds inside the photos. So official with the vibe, you can't fuck up my zone. Hold on for a minute, let me count mine, you know.
Welcome to the Ultimate Wealth Podcast, the show where we unlock the secrets to financial empowerment and lasting prosperity. I'm your host, Derek Passalaqua, and together we're on a journey to transform your financial future and elevate your life to new heights. Join us each week as we dive deep into proven strategies, powerful insights, and transformative stories. Whether you're an entrepreneur, a busy professional, or someone seeking to create wealth and build a lasting legacy, this podcast is your go-to resource for achieving financial mastery and living a life of intentional greatness. This show is about more than just building wealth. It's about creating the life you deserve. So join us and let's build a future where financial freedom is not just a dream, but a reality. Welcome to Ultimate Wealth. Hello and welcome to another episode of the Ultimate Wealth Podcast. I am your host, Derek Passalaqua, and today we're going to talk about something a little bit new and different. We're actually going to start by taking things in a slightly different direction than in previous episodes. And I'm no longer in the financial services industry. And so Ultimate Wealth is ultimately going to take on a whole new meaning and have a little bit different structure and outline as we move forward. So I think one of the things I like most about the title in and of itself is that it's kind of all encompassing in the fact that it doesn't really kind of corner you into any one specific area or kind of like topic of discussion or niche. Because, you know, when you talk about wealth, you can really apply that to almost any area or facet of life in general. So as we move forward, we're going to be shifting things, although we will still be incorporating a little bit of some of the same things as far as like infinite banking goes and how to apply different financial strategies in your life to increase financial efficiency and maximize your effectiveness with generating income and ultimately creating a life that is what you desire and is able to provide you and your family and loved ones with the outcomes that you're ultimately looking to achieve in life. So really just what I want to do first here is just kind of outline and just set the stage, I guess, for exactly what it is that we're hoping to accomplish with the new format, with the new structure, because I want to start recording again on a regular basis. And if for nothing else than just for myself and something to do as a hobby to kill time and just continue to learn and increase my own knowledge and skill set on a daily basis. So first and foremost, I think we want to talk about how to apply different strategies, different financial strategies to achieve not just wealth, but really it's bigger than that. So like a goal or a vision. And I feel like everybody has that kind of a picture in their mind of what they think they want their life to look like. And for me, I know mine's changed a lot over the years, but it's tied heavily to our identity, who we believe ourselves to be, what we think about ourselves, how we feel about ourselves, the emotions we feel on a daily basis. And it's all tied together in the kind of this, big psychological loop, if you will, that kind of defines who we are and who we believe ourselves to be and what we believe ourselves to be capable of. Or not capable of as far as that goes. So my story in particular is I am originally from a small town in Northeast Arkansas, grew up not really ever thinking I was going to go to college, did not go to college, ended up moving up north 3 days after graduating, spent the better part of the next decade in the oil and gas services industry. Really enjoyed it, thought that was what I was going to do forever. Life happens. It's up and down. Ended up getting married in 2016. Did not continue with the oil and gas services industry. At the very tail end of it, owned my own company briefly, ended up exiting that. Shortly thereafterwards, had a 10 to 12 month bout with addiction. Long story there, but long story short, ended up getting help. Ended up not completely tearing my entire life apart. And was able to, very fortunate in the fact, was able to salvage a lot of it. Couldn't have got through a lot of that at the time without the support and help from, surprisingly, not really so much my family as it was my wife's family, my wife herself, her family, and our friend group up here that was able to offer tremendous help and support during that time. And thank God it is now almost 5 years removed in the past. So, but after that, ended up going 2 months treatment services, if you will, completed a 1-year program, and then kind of just never looked back after that. So ended up getting into construction again briefly as a heavy equipment operator, and then got a call out of the blue one day asking if I'd ever considered financial services. At the time, that sounded kind of terrible, so I said no. Another long story short, ended up deciding what the hell, don't have anything to lose, may as well give it a shot. And went and got my insurance license, started selling life insurance, initially for an IMO, and quickly kind of realized that a lot of it was, I don't know, not necessarily a scam, but just not very tasteful, if you will. And so ended up kind of doing my own thing, got with several carriers, and really dug in and did a deep dive into things like the infinite banking concept, the Rockefeller method, how to use whole overfunded whole life insurance from a mutually owned carrier to not necessarily create wealth, but to handle and manage money more efficiently, and how a lot of wealthy families used products like that, or that product specifically, as a place to store and control capital in a very, very tax advantaged way that give them some very, very unique benefits that were not able to be found in any other financial products on the market. And it, to my surprise, really blew me away at the number of not just ordinary people, but actual insurance agents and financial advisors that either had them themselves knew nothing about this method, or B, which may be the more shocking one, was of all the people that did or thought that they did know, about infinite banking and how to use overfunded whole life insurance policy in this way, was the sheer number of people that were in disagreement and just not on the same page as far as its legitimacy and or effectiveness as a whole. So people were just really all over the place. Even to this day, you have, the Dave Ramseys of the world that absolutely hate it and think it's a scam. And then you have the people on the far other side of the aisle that are, think you should put all your income in it and it's the greatest thing since sliced bread. And I personally, after hundreds of hours of research and talking to countless people, have really come to my own conclusion that the truth lies somewhere kind of in the middle. It can be a incredibly powerful financial tool, but it's just that. It's just a tool. It is not a magic bullet. It is not going to solve your problems, and it's not going to help you get to where you want to be in life any better than any other tool can, right? So it's a way to be more efficient. It can give you some very unique benefits and advantages, but at the end of the day, you are the one responsible for you and where you are in life, both now and where you will be in the future. And so if you do not make the decision to get the skills, the knowledge, and the experience that's required to achieve your goals and be successful, whatever that looks like for you, then this product is not going to help you get there any more than any other product will, right? Just like a tool, like a shovel, for example, is not going to help you dig a ditch if you do not put any effort into digging a ditch, if you don't put the shovel to use, if you don't even know what a ditch looks like or what it is or how long it needs to be or how deep. Like, the tool is going to make the job easier, but it's not going to do the work for you, right? And I think that's what's important, is there is no such thing as a free lunch, as a magic bullet. There are no unicorn products that are just going to solve all your problems. We all have to come to that own decision and realization on our own of, like, we are our own greatest asset. And so we're the ones that need to invest in ourselves, work harder on ourselves, as Jim Rohn used to say, than we do on the job, and try our best to become the person that we need to be so that we can go and do the things that we want to do and live the life that we want to live. So with all that being said, the way I want to go, I think, with this going forward is just do my best to share the things I've learned and the experiences that I've had and the lessons it's taught me throughout my 35 years on this earth so far, and hopefully in the process of doing that, be able to provide some sort of value to someone, somewhere, some way, that they can take something away from this, even if it's just one person, and hopefully impact them in a positive way, or if nothing else, hopefully God is able to, in some small way, use maybe some mistakes or struggles I've had or mistakes I've made, and allow those to be a blessing in someone else's life, by not either making the same mistakes or by learning and being able to maybe shortcut some of the headaches and just misery that can be uncovered if you are not careful while going on this journey of life. So let's hop right into understanding, I guess, what does ultimate wealth look like aside from monetary success. So what does designing your ultimate life of what I would call your dream life, right? Like, what does that look like to you? And it's going to be different for everyone. There's no one right or wrong answer across the board. It's really a case by case thing, where for one person, being a phenomenal teacher may be their, dream life. And then for another, it may be becoming a billionaire that invents all sorts of different things that people use. So there is no right answer. There is no wrong answer. It ultimately comes down to what each and every one of us really, truly desire at the end of the day, and what we want things to look like. And I often heard it put that, people have similar to like a thermostat, right, inside of us, and we're all set at a certain temperature. And if we want to move up, get higher, get hotter, get more on fire for success and for things in life that we care about and that matter, and become a better, higher level type of person, the best way to do that is to put yourself around other people of that stature. And the thermostat analogy is, if you're a 65 degreer, but you go hang out with 70 and 75 and 80 and 85 degree people, then you're going to get warmed up towards their level. But in the very same sense, if you're a 65 degreer and you're hanging around with 50, 40, 30 degree people, you also will move to their level. And so everybody's heard the saying, you're the average of the 5 people you're around the most. And there's a lot of truth to that. If you hang out with scumbags, you'll become a scumbag. If you hang out with millionaires, you're likely to become the next one. And it's just really hard to learn from people that aren't living the life you want to have. I would never take advice from someone who doesn't have a life you admire or envy, at the end of the day. So when we talk about how can we be successful outside of monetary things, I think that's important to keep in mind. So the purpose of the new version of this podcast is really just to share proven, powerful strategies that will help you grow your income, build wealth, and transform your life closer and more aligned with what you want it to be. So what you can expect from these new episodes, there's going to be a lot of strategies that are very unique, non-traditional, actionable insights, as well as deep dives into different topics like infinite banking, alternative wealth creation methods, real estate investing, marketing, and just income generation and tactics for building wealth and a life of ultimate wealth. Okay. And so one of the things I would say is that one of the kind of most real important, or not important, I'm sorry, one of the trendy things that's kind of a fad you hear a lot of people talking about today is being a serial entrepreneur, right? And they're doing 15 different things. And the problem with that is that you can usually never spend enough time on the one thing to achieve mastery and to really get it to where you need to be. And so they're attacking 15 different things at once. And in turn, they never get anything accomplished or really ever move the needle with any of them because their attention's scattered and all over the place. We have limited attention. We have limited energy. And so when you're trying to spread that very finite amount over all these other, various things, it's almost impossible to ever get good enough or develop the skills necessary at one thing to see measurable results, much less desirable ones that you're out and seeking to achieve. So what I would like to do right off the bat is I want to highlight just a few of what I would say are high income generating, or that have the potential to be high and rapid income generating strategies. Okay. And then I'll talk about how you can use different tools to kind of expedite this strategy. And depending on what you want to do, and what your goal is, what the end goal is for you, you can see some of this will apply, some will not, basically. Okay. So for me, I have what I would call the backstop for everything. And then there's the strategies. So there's principles and strategies, and they're two different things, right? Principles are kind of what guides your decision making, and what you believe in and the way you kind of go about things. And strategies are simply the plan to implement the implementation plan rather, to achieve a result, right? So you use a strategy to achieve a result, but you use your principles or what kind of guide you on decision making as you implement the strategy. All right. And so I think it's important to really understand and know the difference between the two. Okay. Because in order to achieve any result, you need to have clarity, would be, I would say, step number one is achieve ultimate clarity around not just where you want to go, but where you are currently. And that starts with having an honest conversation with yourself, taking a inventory and figuring out where is it that you want to go. That's first. Where do I want to go? And then where am I now? Okay. Because once you understand where you're at and where you want to be, then and only then can you map a kind of a roadmap or a blueprint to get from point A to point B. Okay. It's really as simple as that. Now, for some people, maybe that is having multiple different income streams. But for most people, it's getting really good at one thing, creating a lot of leverage around something that you're already very good at, and then exploiting that and using that and hitting the leverage button over and over and over again until you break the damn thing, and then you rebuild it bigger and you keep smashing it. And then if you ever do achieve true mastery, then sure, at that point, I would say most businesses, the best strategy or formula that they use for success is simply do as much as you can do to make as much as you can make, and then try to automate. And automation can save you a lot of time. It can help you scale, and it can be a great equalizer. So some of the industries that we think of, because at the end of the day, it's all about cash flow, money in versus money out, right? And so some high leverage, quick cash flow opportunities would include things like real estate wholesaling, digital marketing and lead generation, high ticket coaching or consulting. And one of my favorites which is leveraging AI and automation tools to help small business owners get results faster and more efficiently. Things like Go High Level CRM, running ads, stuff like that. And then there's even a world where you could really combine all of these into one. And because every business has to have, or doesn't has to, but should use, in my opinion, digital marketing and lead generation, right? Every person that has had any sort of life experience could potentially be a coach or a consultant. And every business should at this point be leveraging, at least to some degree, artificial intelligence. All right. And then to take things a step further, let's break down what is the infinite banking concept, because I think it's important to understand really what it is first and foremost, because once you understand what it is, then you can kind of see and understand how you could use and implement it to increase your financial efficiency and effectiveness. So it is, simply put, it is a strategy for using money and controlling it more efficiently and more effectively in a more efficient manner. It's a way that can control cost, allows you to control your cost of capital, limit your opportunity cost, because there's always opportunity cost attached to everything. So you want to try to limit that as much as possible. You want to control your cost of capital. You want to have more options, because typically more options is better than less options. And you want to be efficient. And it's really built on three foundational pillars, which are control, growth, and safety, right? So when you think about putting your money somewhere, you want to put your money somewhere that is going to be safe, that's going to be liquid, okay? I said safety, control. I meant to say safety, liquidity, and growth. So you want it to be somewhere safe. You want it to be somewhere liquid so you can access it should you need it. And you want it to be somewhere where you're going to get decent growth on that money. Okay. Now, when we talk about having these three things, what comes to mind? So maybe a money market account or a savings account at the local bank, some sort of an investment account or a 401k, IRA. Well, let's break it down. So safe, meaning, in my opinion, that the difference between saving money and investing means that there is an element of risk. Simply put, the chance for loss. So if you want your money to be safe, there cannot be a chance for loss. Therefore, it cannot be an investment because you cannot have risk. So that automatically is going to roll out any investing accounts. So that pretty much leaves us with a savings account, a shoebox under the bed, or, in my opinion, the best place of all, which is whole life insurance when set up and used properly. And there's a very, very, very big asterisk there, because the traditional whole life insurance that your Uncle Bob has or Grandma Susie has is not a good place to store money. It is not a very efficient place to keep your money. And it is certainly not going to be somewhere you're going to get any kind of growth or have any kind of decent liquidity, at least not for the first several years. So when I'm talking about life insurance, I'm talking about a very, very, very specially designed and engineered whole life insurance policy that is set up completely ass backwards from any other policy It is from a mutually owned carrier, not just any mutually owned carrier. It has to be one of, I'd say there's really only about 10 or 11 in the whole country. If you live in the United States, that can really be utilized for this. And it has to be done by an agent that knows what the hell they're doing. And that's really the most important thing. So it has to be safe. It has to be liquid, meaning you can access it. You don't have to sell or trade or what you like. Liquid simply means like a savings account. You have money in a savings account. It's sitting in there. It's safe. It can't lose money because you're not gambling it. Okay. And then it's liquid, meaning you can go withdraw it immediately anytime should you need it. Okay. So safe, liquid, and then growth, right? And this is kind of where the savings account, I would say maybe in most people's minds, is winning right up until here, because even in a high yield savings account, the growth is terrible. You're usually not going to be able to outsave inflation at the end of the day. And then you still have to pay taxes on that money, on the growth. So sure, it may be safe and liquid, but in my opinion, it's not even an opinion, it's a fact. Every day your money sits in a savings account, you are losing money to inflation and taxes, because whenever, say you let $100,000 set in a high yield savings account for 20 years, when you go to withdraw it, you're going to have to pay taxes on all that growth. Okay. And then between that and inflation, if you put $100,000 in, it's probably going to be worth far less than $100,000 in 10 years from now, because thanks to inflation, and inflation's never going to reverse or stop. It's just the rate at which it is accelerating can be slowed down. But things will continue to be more expensive and more expensive and more expensive. And the dollar will continue, as long as they're printing it, to be worth less and less. It is no longer a store of value. It is a Federal Reserve note now, even though the Federal Reserve is neither federal nor a reserve, but that's another conversation for a different day. So again, a savings account or a whole life insurance. Now let's look at a whole life policy, because a savings account does give you safety. It does give you liquidity, but it does give you growth, but it's just not very good growth, like we just discussed. So now if you look at a properly engineered, properly set up, used, and designed whole life policy, it is extremely safe. Think about this. Most banks, okay, the biggest banks in the world, keep billions and billions of dollars in whole life insurance. It's called BOLI, BOLI, which stands for Bank Owned Life Insurance. If we just do a quick search and see how much money do banks own in life insurance, all right? So let's take a look at Investopedia and see what it says. It is, let's see, life insurance is a product where the bank is the policy beneficiary and usually the owner. Such insurance is used as a tax shelter for the financial institutions, which leverage its tax-free savings provisions as funding mechanisms for employee benefits. Right? So bank-owned life insurance is a form of life insurance used in the banking industry. Banks use it as a tax shelter to fund employee benefits. A significant concern for banks is the credit quality of the BOLI issuer. The policy is bought on an executive's life, and tax-free benefits are paid on the executive's death. Even if an employee covered by BOLI leaves or is terminated, the policy on them remains in place. So what I wanted to see was, how much money do banks own in life insurance? Let's take a look and see, because you get some very unique benefits. Okay, here we go. According to a report from 2020, 2/3 of U.S. banks hold bank-owned life insurance assets, and $182 billion is the total cash surrender value of all the policies as of December of 2020. 3,137 banks nationwide reported cash surrender values on their regulatory filings. 67% of banks nationwide with assets between 100 million and 1 billion currently own bank-owned life insurance. The following banks have the following cash values of life insurance assets: Bank of America, 24 billion; Wells Fargo, 19 billion; JP Morgan and Chase, 12 billion; PNC Bank, 10 billion; and Truist Bank, 7 billion. Again, that is the top 5 banks and what they currently hold in what's called BOLI, which is bank-owned life insurance. And why that is significant is because, and why would they do that? Okay, is very simple. It boils down to the unique advantages that it provides to people. And again, regardless of if you're a banker, if you're just a normal average consumer, if you invest in real estate, if you're a business owner, it gives you some very, very special, unique advantages. And there's a reason that they do that. So the insurance companies, they're very, very good at one thing, and that is preservation of capital. There is no company better on planet Earth at protecting and growing your money than an insurance carrier. And thanks to the IRS tax code 7702, you get some extremely amazing, unique benefits as a policyholder of permanent life insurance, specifically whole life insurance. So I want to be very clear. I'm not talking about universal life or indexed universal life here. I'm referring to whole life insurance, and you will see on TikTok and Instagram and all sorts of other social media platforms, a lot of, especially agents, like to do this, take advantage of and try to incorrectly hang on to the coattails and use the facts and figures that are associated with whole life insurance and try their very best to claim those things to be true of IUL. That is not the case at all. And the reason they do this is because in most places where they are talked about, it's just referred to as permanent life insurance. And since IUL falls under the category of permanent, it's a type of permanent life insurance. They like to try to kind of, take credit for some of the things that whole life has done. And what's interesting about that is that IUL has only been around since 1997. Transamerica created the first IUL in 1997. It had pretty much zero market share until after 2008, when that big real estate bubble crashed or popped. And then people started really buying into that upside potential and downside protection story. And that's kind of when it blew up. And then currently, as of today, June 2025, it is the fastest growing product on the market, unfortunately. And it is very, very widely misrepresented, and it is sold. Most of the people selling it, and I would say over 90% of the people selling it, unfortunately, have absolutely no idea what it is they're even selling. They get a few talking points from their upline, from their IMO, and then off they go. And they're playing with clients, retirement money, and unfortunately, in a lot of cases, and it's kind of a scary thing because there's going to be issues. The average agent's not in the industry more than 5 years. So what's going to happen is there's going to be people that run into a lot of issues, unfortunately, and there's going to be no one to be held accountable because they're no longer even going to be in the same damn industry. But thankfully, that's no longer my problem because I'm no longer in that industry. So that's a different topic for a different day. But anyways, back to the bank on life insurance. The reason banks keep so much money in there is because they are allowed to classify it as a tier 1 asset. And a tier 1 asset is the safest place that you can store capital. It is considered the safest place to put money, period, is a tier 1 asset. Okay. And so the reason they put as much as they can into tier one assets is all the benefits that come with this one in particular tier one asset of BOLI, bank owned life insurance. And so some of these benefits include and this does not just apply to banks. This applies to both banks and consumers alike. So even if you, Joe Schmo, that works at Walmart, gets a policy for yourself, like this will apply to anyone. Even if you don't get a specially designed policy, some of these still apply. So you get tax-free growth, tax-free access. It gives you the ability to get a tax-free death benefit, which is a multiple of whatever your contribution is. Meaning, say you pay in over a course of 20 years, $100,000, okay? You get a multiple of that, or not you, but your beneficiary receives a tax-free multiple of that number, meaning like 10 times that amount, right? Depending on the age and your health when you buy it and how it's set up and all that. But like, if you got like a single premium policy, for example, if you put 10 grand in, it would probably pay out a death benefit of say $1 million if you were 30 years old or something. That's just a really vague example, but that's what I mean when I say it pays out a multiple. Okay. So if you have money that you're paying in, another thing you get is an increasing death benefit. So every single year, your death benefit increases. Every single year, your cash value increases. So these policies they're broken down. Think of them, they have two compartments. Okay. One compartment is the life insurance, the death benefit. Okay. And the other one is the cash value, which is, you can think of it like a savings account. Okay. So when you make a premium payment, all right, every month or however often you decide to set it up to pay it, could be monthly, annually, quarterly, however you do it, a portion of that money, so say you make $1,000 a month payment, a portion of that money, okay, is going to go to cover the cost of insurance, the death benefit. All right. Now, the other part of that money is going to go towards what's called the cash value through what is known as paid up additions. So what these paid up additions do is they actually allow your death benefit, your cash value, when you use the right policy type and you set it up correctly, they allow your death benefit and your cash value to grow every single year. And when set up correctly using the correct type of policy, usually by the third year, your cash value will increase by more than your annual premium payment. So say you're paying in, let's just say you're paying in $1,000 a month, which is $12,000 a year. So you'll see, if you look at the illustration, this is contractually guaranteed that at the end of the third year, okay, you'll have paid in $12,000 for that year. Okay. If you look over at the dollar amount that your cash value has increased by, it will have increased by more than that 12K. All right. So, and then that spread gets wider every year. So if in year 3, if you put in 12K and your cash value increases by say 14K, then by year 20, when you pay in your 12K, if you're still paying premiums that long, your cash value is likely to be increasing by double or triple that amount. So 24 to 30K. Okay. It just gets better and better and more efficient as time goes on. So, and again, all of that growth is able to be accessed 100% tax-free. It grows tax-free. It's accessed tax-free, and you're able to pass it on tax-free. There is nothing else in the world that can come close to doing that. Now, here's the other magical part. You can also borrow that money, right? So, and you're not borrowing your money. You're borrowing the insurance carrier's money. So I hate when people say, why the hell would you pay interest to borrow your own money? You're not. You're just like if you're borrowing from a bank, the insurance carrier is the bank though. So you're borrowing based on your cash value, not based on your death benefit. So if you have $100,000 of cash value inside of your policy, okay, you can borrow say 90,000 of it. Some companies you can borrow the full amount, but let's just say you borrow the full amount. Let's say you have 100K in cash value inside your policy. Okay, you have a death benefit of, let's just say, $1.2 million. It'd probably be a lot more than that, but we'll say you have 100K in cash value and you have a death benefit currently at 3.5. All right. So here's what they're doing. You want to borrow that full 100K. So you can borrow the full 100K, and now you go stick that into a real estate investment, like a multifamily unit property. Okay. And with you had that 100K sitting in a savings account and you took it to go stick in a real estate investment, what would happen? Would you still be earning interest on the $100,000 inside of the savings account? No, you wouldn't. Because your money with a savings account can either be here or there, but it cannot be here and there, right? Same dollar cannot be in two places at the same time. That's impossible. Well, however, with a whole life insurance policy, that is not impossible. So if you have 100K, like we said, in cash value, and say you had the $3.5 million death benefit, and you borrowed the 100K out of your policy, all right, and you to go invest in real estate or whatever, it can be whatever you choose, all right, you're going to get charged 5% roughly by the insurance carrier, because they're going to loan you that 100K. They're going to charge you 5%, same as a bank would. All right. So as long as the activity, in this case, real estate, is earning you a higher return than that 5%. So let's say the real estate is making you 10%. All right. So now you're being charged 5%, and you're using the money where you're being charged 5 to go and earn 10. Right. That's a 5% difference. Right. So you're making 5% on the borrowed money, but that same 100K that was in your policy that you borrowed against, it is still earning its guaranteed interest rate and dividends as if you never touched it, meaning that $100,000 is now working for you in two places at the exact same time. You're making 10% out here, and let's say you're making 4% inside your policy. Okay. So, and that's IRR, internal rate of return, we'll say, in your policy, 4% net of fees. So if you're making 4 and 10, that's 14, and you're being charged 5, right? That's 9% that you're earning on your money. Instead of, let's do the other example with the savings account. You do the same thing. Well, now you're only making 5%, right? If you had a savings account where you had $100,000, all right, you stuck it in that real estate earning 10, but they were charging you 5, then now you're only earning 5. So that was the difference right there. Just that's one of the differences, you sound like, some people would say, look, that's not a big deal. It's only a 4% difference. Like, who cares? Well, when you consider the fact that 100K that's inside there, it's growing and compounding annually, uninterrupted, and then you can continuously use it for whatever you want, whenever you want, that little 4% is going to keep getting bigger and bigger every single year and get more and more efficient. But here's the kicker. It's tax-free. So even if you got to pay tax on that real estate, right, the growth inside the policy is tax-free. So that 4% now looks like maybe a little bit more like 6, 7, 8, maybe 8 to 10%. By the time you factor in taxes and inflation. Because whole life insurance it's a non-correlated asset. So it's contractually, it's a unilateral contract, meaning it is contractually guaranteed to increase in value year over year as long as you hold up your end, pay the premiums that are required. The insurance carrier is on the hook for that death benefit no matter what, because they are one of the only companies, or actually I think they're the only type of company in the world that is averaging both mortality and longevity, right? So nobody else does that. No other company does that. They're hedging both bets. If they're hedging the fact that if you die, they're going to be paid back. And that's the other thing. Some people say, well, I'll just borrow the money. Okay, well, now you have this obligation with life insurance. The loans are unstructured. You have creditor protection. Okay, you have living benefits. If you ever get sick, you have the ability to advance, a very high percentage, depending on the carrier, of your death benefit. But the loans are non-structured, meaning you pay them back when and if you feel like it. You could make interest-only payments if you chose to, right? So it just gives you so many more options. Like I use the example all the time, the difference in buying a car and paying cash or taking a loan from the insurance policy. Some people say, why would you take a loan at 5% if you could pay cash? But you have to understand that you're always paying interest. You're financing everything we buy, right? Because you're either paying interest or you're giving up the ability to earn it. So if I take $1 and go to the store and buy a drink, and I say I just paid cash, well, you still financed it, because now you just lost the ability. This is what opportunity cost is. When you spend $1, you don't just lose the $1, but you lose the $1 and everything that $1 could have earned you for the rest of your life. The money's gone if you just spend it. But if you first take it and put it into one of these policies, then that money will continue to grow, guaranteed. Every year it will increase in value for the rest of your life, while still having the ability to access and use it tax-free, while it grows tax-free anytime you'd like. There's no contribution limits. And I'm not saying it's an investment, because it's not. It's a savings. It's a place to store and control capital that allows you to be more effective and more efficient. I hope you got a lot out of this episode today. Unfortunately, we're out of time, so we will pick up next week. But hopefully you learned something. Let me know in the comments if you have any questions, what you think. If there's anything, you got any value out of this, please share it with someone. Don't forget to like, subscribe, and follow, so that way you can be notified every time we release a new episode. Like I said, we're going to get back on trying to release at least one a week, if not more, and provide as much value as we possibly can for you guys. So again, I really, truly appreciate it. Thank you from the bottom of my heart. Hope you got something out of this that maybe made you think differently, look differently. And if you disagreed with me, it's okay. I can take it. Let me know in the comments. Love to have